This is Dirty Little Bank Secrets Part 5, and not really dirty little bank secrets, more like dirty ATO tax secrets. So currently we have 3 more days before the 2023 financial year ends. So a lot of people are trying to claim a tax deduction. And did you know if you buy an investment property and it exchanges before the 30th of June right now, and if you paid stamp duty on that investment property before the 30th of June in this financial year, well, that's a tax write-off and tax deductible. Hold on a sec, Q. You're saying if I bought an investment property and paid stamp duty, that's tax deductible and can be written off as a tax write-off? What? That's correct. That's the dirty ATO secret. If you bought an investment property this financial year in Canberra or ACT, the stamp duty only in Canberra can be written off and be tax deductible. And the reason for that is, and the ATO has commented on this, is that the leasehold on the ACT is a crown lease for 99 years, and such you can claim an immediate deduction for your stamp duty on my tax. To be more specific, on the ATO community website, it says if you look at our rental properties 2021 guide under expenses for which you can claim an immediate tax deduction, you may be able to claim an immediate deduction in the income year you incur the expense, which is the stamp duty expense that you paid. So let's go to the drawing board and let me illustrate this for you. If you purchase a $400,000 apartment, for example, in ACT, because you're a greedy landlord, you only want to put in 10% deposit. So basically you borrow 90%, that'll be a $360,000 loan. The interest rate is at 6.5 interest only. That will be $23,400 per year in terms of interest expense. Mortgage insurance added on that would be about $8,000. And here's the beauty in ACT, the stamp duty, which is about $8,000. Based on this stamp duty calculate for the 2023 financial year, $8,000. This is tax deductible, this is tax deductible, and this is tax deductible. Again, this is not tax advice, but potentially $39,400 is tax deductible against your income. Say you go to an income tax calculator that I found on Google, and for example, you earn 200 Gs per year. This is the tax you got to pay, and you're going to be marginally taxed at 47%. This is some fancy diagram they pulled up, and basically you're going to pay $85K in tax that year. But because you're PAYG, which is pay as you go tax on that 200K, you already paid that tax. So when you go to your accountant to lodge your tax return, you can ask them, can I get a refund? Because, for example, during that financial year, you were renting the place out, this new place, and you only made 20K in terms of rental income. Well, that minus that, you made a 19K loss. Now, again, this is not tax advice, and this is a very broad stroke tax application. For example, 85K was paid. 19K, which is the loss over here, negative gearing can be claimed against this, which means you should be paying tax on 66K. So overall, you should get a tax refund. But again, only ACT. Let me know what you think.